Hi, welcome to my channel. Today I want to share with you my updated valuation of Berkshire Hathaway. They reported fiscal year 2021 results on Saturday and a couple of days ago, and I'm going to update my valuation based on that information. In this new video, I'm going to follow the same methodology I used in the previous video I uploaded in March 2021, where I calculate the fair value of Berkshire based on the sum of the parts of 6 different components, and these are the excess cash in the balance sheet, the value of the non-controlling investments, the railroad, the value of the energy business, the value of the manufacturing services and retail businesses, and the insurance businesses. I also encourage you to go and check the previous video. I'm going to link here and also below in the description, because in this new video probably I'm going to skip some of the details that I go through in that other video. So let's go to the sum of the parts approach. So the first thing we do is go and check the cash in the balance sheet coming from these 3 different items, and the 3 of them add 160 billion. And then I subtract 30 billion. This 30 billion is what Buffett wants to keep in the balance sheet at all times to run the business in a safe manner. So if we subtract that, we have as excess cash and ready to be invested 130 billion. So this is part of the value I'm going to consider for Berkshire. It's also possible to say that this is more than 130 billion. You can multiply that by a factor. Assuming that there is some optionality on this cash, that Mr. Buffett can put it to work in a profitable manner. But I'm going to use just the fair value, let's say, of the cash. So then we go to the investments, and we found that in the balance sheet as well. Investments in equity securities, 350.7 billion. And this is the market capitalization of all the investments as of the end of 2021. Buffett in his letter discusses these investments. He shows the 15 largest here, and he says that of these 15 largest, several are the selections of his 2 long-time investment managers. So not all of the investments here are made by him. These investing managers have a total authority of 34 billion. So the list is this one, and this is the 350.7 that we saw on the balance sheet. And he goes on and says that Berkshire also owns 26.6 in Kraft Heinz and 38.6 in Pilot, which is a leader in travel centers that has revenues of 45 billion. So I'm going to add these 2 to this 350. So this is what I do. This is the list of the 15 companies plus these others, and the 350 billion of market capitalization. I compute the fair value of each of these, and I come with 310. So it's a 13% overvaluation, let's say, on the price. Then I add Kraft Heinz and Pilot, and I add them together. The overvaluation of all this is 11%. So I come with 343.7 as the value of all the holdings plus, in the balance sheet, plus the ones that are not reported in the balance sheet. So the valuation so far would look like this. We also have to consider the deferred tax liability, which we can see here in the annual report, and we see the value is 55 billion, and this is the unrealized appreciation of the investments. So if Mr. Buffett were to sell all the marketable investments today, the appreciation and the capital gain that will entail would result in a payment of 55 billion in taxes. But because this is not going to happen today, and probably it's, who knows when it's going to happen, if ever. I mean, of course he's going to sell something, but not all of it. So what I'm doing is I'm trying to come with a present value of that future payment of capital gain taxes. And what I did, and I explained that in my previous video, is I divide this number by 2. So the present value of the future liabilities is going to be 50% of the nominal value in my calculation. So far, the value of Berkshire is 446 with these 3 items. Now let's go to value the 62 fully owned businesses, which are listed here. We have the railroad here. Then we have a list of 14 insurance companies. Then we have 45 in manufacturing, service, and retailing. That they put them all together. And we have the utilities. Plus this Home Service of America, which is within Berkshire Hathaway but has nothing to do with energy. So okay, let's go and value the railroad. Here in the annual report we get the income statement of the railroad, and what I did was I compiled that in this table, and we can see here the results of the business and the operating ratio, which is quite an important number for the railroads. As you can see, it's been decreasing, which means the railroad has been improving in its efficiency. Because this number here represents the operating expenses versus revenue, and of course, the lower the expenses to operate the business, the better. I'm going to use Union Pacific, and I have similar information here as a proxy to value BNSF, because they are very similar in size and they're very similar in the area of the US that they operate. In fact, in terms of revenue, they are very similar as well. If you see here, the operating ratio of Union Pacific is much better, and here is the difference. It's 2%, 6%, 4% better than the BNSF, and that reflects in the net income. If you see the net income here, or in this case the pre-tax earnings, are larger for Union Pacific with a smaller revenue. But in any case, I think this is a very good proxy. Because this company is public, we can get the market capitalization, therefore the price earnings and price sales, and also the intrinsic value that I am calculating as 140 for Union Pacific, and this is the summary of my calculation. If you see here, the price at which it's trading today is 246, and my fair value is around 209, so 85% of the current price. So it is overvalued by 18%, 1.18, the price to fair value. So that I will consider here, and to value Burlington Northern Santa Fe, I'm going to use this price earnings and this price sales instead of this one, because of this overvaluation that I'm assuming. So I go to the BNSF numbers, and with this price earnings and price to sales, and with this sales and this net income, I compute what would be the fair value of BNSF. And then what I do is I average these two, and I come with the valuation of BNSF, 136 billion. Another way to compute the fair value of BNSF is to use a larger benchmark and use all North American Class 1 railroads. And in this pie, I show the ones I'm going to use, including BNSF here, to show you by market capitalization how large, let's say, is each of them. So you can see Union Pacific and BNSF, these two are the largest. I build this table because all of these are public companies. I can compute the price to sales, price earnings, price to cash flow, and I also compute the fair value, and I average them, and this is the fair value. They are 14% overvalued as a group in my view. And then with the sales, net income, and operating cash flow, which I use EBITDA as a proxy for operating cash flow. And with these numbers, I calculate the market capitalization of BNSF using the average ratios. I divide this by 1.14 due to this overvaluation, and I come with this fair value, and the average is 141. So you see that it's a similar number than the one I came using only Union Pacific. 137 versus 141. A third check of the valuation is this one. In Buffett's letter, he mentions the 4 giants, the 4 largest businesses in terms of value for Berkshire, and he says that leading the list is the cluster of insurers. Then second, he mentions the market capitalization as of the end of the year of Apple, which is $161 billion. And then Mr. Buffett mentions BNSF as the third giant, and my calculation is 137, so below Apple market capitalization, so it's a number that fits the information that we got from Buffett. So now we're going to go to the energy business. So to value the energy business, I use these 7 utilities as the benchmark, and these are the same I used in the previous video. I come with a price earnings, price sales, and the price operating income, and the price fair value, and the average of each. And then I multiply the net income of Berkshire Hathaway Energy times the price earnings, and I get the market capitalization. And I do that for each of these, and I get these 3 potential market capitalizations that I average together and get this fair value, but I divide the average by 103, which is, in my view, the overvaluation of these companies as a group. So this is the one I'm going to use, 69.1 billion. And these numbers, the net income and sales and operating income, are coming from the annual report. So in this page of the annual report, we get the revenue, we get the net income attributable to Berkshire Hathaway Energy, and then the pre-tax earnings plus the interest expense would be the operating income that I am using. Now let's go to value these 45 companies, and I'm going to use the similar approach that I used for energy. I'm going to come with 25 companies which are all in the manufacturing, servicing, and retailing, and I came with this list in the previous video as well, so I'm going to use exactly the same companies. I use the price earnings, price sales, and all these metrics, and then I average them. I go and take from the annual report the net income of this manufacturing, services, and retailing, the sales. I calculate the forward net income as 9% growth from the net income of this year, because this is the growth that they have been experiencing in the last couple of years. And then I compute the operating cash flow as using the EBITDA as a proxy. I'll show you in a minute where these numbers are coming from, but what I do is I use each of these numbers, I multiply them by the respective ratios, and I come with a market capitalization for each of them. Then I adjust that with this 104. I divide all these numbers by 104, which is the overvaluation, in my view, of all these companies as a group. And then I average these 3. I do not consider the sales, because you see it's a very large number, it's an outlier. So I'm going to average these 3, and this is going to be the 275 that I'm going to use for this group. This is where the numbers come from. This is the results of operation, the net earnings for the manufacturing, service, and retail. And here in page K110, we get the revenues, which is the sum of these 3, manufacturing, McLean, and service and retailing. And I can calculate the earnings before taxes plus interest expense, and then plus depreciation, and I get a EBITDA. And that's what I use as a proxy for operating cash flow. So then the fair value so far would look like this. So these 3 segments would be valued at 481, and the balance sheet items will be valued at 446. So now let's go and value the insurance business. So the valuation of an insurance business comes from 2 sources: the underwriting business, which is the premiums less the claims less the operating expenses. That gives us the profit or loss per year, and then the proceeds of the investings of the float, which is dividends and capital appreciations less cost. So how do we value each of these? Well, the underwriting profit, which I'm going to consider, is going to be 2.5% the premiums, and the premiums on 2021 were 69 billion. These 69 billion are taken from here, the same page K110 of the annual report, and this is the number 69. And insurance underwriting, and this is revenues. So, and then this times 2.5% is 1.7 billion, and I multiply that by 15 times as the price earnings, and this is the value of the underwriting business. And then the value of the investing business, let's say the investing value, is the value of controlled, non-controlled, and cash that I have already calculated. So the only thing that needs to be added to the value of the insurance business is the value of the future float, because what I have considered so far is what has been done with the float that the company received up to today. But if the business keeps growing, that float will keep growing and will keep generating value. So I came with an exercise, and you can see that in the previous video, but I'm not going to repeat it here. And I came with a 42 and something billion dollars as the potential value of that future flow and the future investments of that float. And regarding float, Mr. Buffett always discusses that in all his letters, and in this the last letter he said that the total float has grown from 19 million when they entered the insurance business, and that was 55 years ago, to 147 billion. So if we make the calculation of that, that means 147,000 million divided by 19 million, that's 7,700 times, and that's in 55 years. So that is a growth of 18% per year on a compounded annual growth basis. This is amazing. Of course, it's not going to grow that fast in the future. It grew 9% the last year, as he says here. He's saying, if you're not familiar with the concept of float, he refers us to page A5, and I recommend you to read that because it's a great explanation of what float means. And to his surprise, the float increased 9 billion last year. And he says, a buildup of value that is important to Berkshire owners, though it's not reflected in our generally accepted accounting principles presentation of earnings and net worth. So this is a very important concept. In Mr. Buffett's eyes, float is not a liability, in fact produces value. And this is what I tried to capture when I came with this exercise of the future float, and I came with $43 billion that I'm going to show in this table. So this is the future float of 43 billion that I calculated. This is the 26 billion I already explained. And so this we add to what we have seen in the previous steps, and we come with $997 billion as the fair value to Berkshire, in my view. If we divide that by the B shares, we'll get 440, the total fair value per B share, 440. If you see today, the stock is trading at 319, so that means a price to fair value of 0.72. So this is a 28% of margin of safety. So 440 could be a large number, I don't know. It looks like a large number compared to the price, but I don't think that my assumptions are overly optimistic. I think they are reasonable. And so I think that 440 is in the ballpark of the value per share. So not only is a great company to hold for a long time, but you can buy that company today at a very substantial margin of safety. Let me show you another check why I think this valuation of 440 is per share is not overly optimistic. If we go to the Buffett's letter, where he mentions the 4 largest sources of value for Berkshire, he said that leading the list was the cluster of insurers. Then he said that the second was Apple, the third was BNSF, and the fourth was the energy business. And so far, in our computations, all of them seem to be in the same order than Mr. Buffett. But we haven't computed the value of the insurance business, so this is what I'm going to do. In this table, we're going to take out the non-insurance businesses, which are 798 billion. So the remaining is going to be insurance business. So if we go to the same list of the 4 giants, this is what we have. Insurance business 200, Apple market capitalization 161, BNSF 136, and energy 69. So it meets, let's say, the criteria of value that Mr. Buffett mentions in his letter. And if you see, the value of the insurance business comes from the cash plus the insurance business itself, the underwriting, plus this item that I call value of future float, and I don't know what Mr. Buffett can call that, but if this were not there, the value of the insurance business would be only 130 plus 26, less than the Apple capitalization. So some type of valuation he's putting to the float or to the future of the business, other than what we can see just by adding cash and the operations of the business. If it's more than 200, better, because that means that this is more than 440. If it's a little bit less, even if it's 160, the company should be worth 930 billion less, 960, which will give us roughly $420 of fair value. That still gives us a large margin of safety to the price that we have today. The other thing is that Mr. Buffett has been buying back the stock, and he always says that he's not buying back stock if the stock is overpriced. Even though he mentions that it's mildly undervalued, let's say. We never know what mildly means for him. So the fact that he's been buying so much, and he bought in the first month of the year as well, that gives me quite a high level of confidence in this valuation that I just made. So if it's 420, 440, or even 400, it's still a good margin of safety versus the price that we have today. So that's my take on the valuation of Berkshire Hathaway. I was pleased with 440. I wasn't expecting such a large jump. The previous video in March, my fair value was 330, and the stock was trading at close to that price. So now 440 gives me a large enough margin to keep investing in this great company. So probably I'm going to do so. Don't forget to subscribe to the channel, and if you like the video and you learned something, please give it a like, and also click the notification bell. And I'll see you soon, probably in a week's time, with another valuation video. Thanks very much for watching. Bye bye.